I'd say one of the things I've learned is that you're, unlike a lot of other lenders in the space, you'll actually give people reasons why you've turned them down for a loan. Walk
Yep.
me through, think of like the last two or three times you said no and a deal just didn't pencil out. Walk me through some of the reasons why a hard money loan would not be facilitated if, what those reasons look like.
So the first big one is lack of organization.
Okay.
Organization is really, really super easy to spot. When you apply for a loan, every borrower knows they have to provide documentation to back it up, right? Because we as lenders, we need to know your legal name and the address and the phone number, right? We have to have that stuff just to document things properly. It never ceases to amaze me how many borrowers who've done deals in the past have no idea what they need to turn in, or are just so disorganized with the data that we have to request it 15 times. If you make it too hard on us and we have to just work just to get information from you, we usually just decide to walk away because the money isn't worth it,
Yep.
right? So disorganization from borrowers is huge. Um, Next one would be bad comps. We get a lot of borrowers that come to us and they go get some comps, and they'll go to the realtor, which is great. I mean, that's supposed to be where we go. They'll go to a realtor, except they don't get a realtor who understands what we're doing. They just pick a realtor. And that realtor is used to trying to sell the biggest numbers possible so they can get listings. And so when you get realtors involved who really don't understand the real estate investment game and that we're looking for a conservative number, now we're hoping for the bigger number in every case because that means more profit to the borrower. But you want to come in and look at your deals from a conservative standpoint. So we get comps sent to us as part of the deal analysis that the borrower does that are, honestly, they're delusional. They're 50,000, 100,000 higher than what reality is going to be. It usually kills the deal because they negotiated the purchase price based on these inflated numbers. And so when you put reality to it, it leads into the third one, which is they don't have enough money to put into the deals, right? And so when you screw up your comps and you screw up your analysis, it creates a situation where, under a good deal scenario, sure, you might have to put some money in, but relatively speaking, it's a lot smaller than a deal that's way out of whack. You might come and have to put 20 or 30,000 into a deal, bring a deal that's screwed up, and you could come with 75, 80, 100,000 to make it work
Got it.
because lenders have limits, right? So we can only lend up to, say 70% of whatever the value comes in at for that we determine, right? And if it's delusional, we just move your number down to what fits conservative, recalculate, and then all of a sudden the amount we can lend you is way less than you expected. And so the deal will die because the money just doesn't work anymore. It might still work for us because we lowered the LTV or lowered the valuations down, but it's not really a good deal.
Got it.
So it'll get kicked out for money reasons.
Got it. So for the latter two, not necessarily the disorganization piece, but the latter
Yep.
two,